You hear about it on the news all the time, right? The stock market is up, the stock market is down. But what does that actually mean? What are you really buying when you buy a stock? Well, today we're going to break it all down and demystify it together. So let's just get right to the heart of it. When someone says they own stock in a company, what does that actually look like? I mean, what does it really mean to have that piece of paper or that line in your account? To get a grip on the whole system, we have to start with the most basic building block. So, first things first, what is a stock? It's actually pretty simple. A stock is just a small piece of ownership in a company. Think of a company like a giant pizza. Buying a stock means you're buying a tiny slice of that pizza. And each one of those individual slices, that's called a share. The more shares you have, well, the bigger your slice of the whole pizza. Okay, definitions are one thing, but to really understand why stocks even exist in the first place, let's make it real. We're going to follow the story of a small business with a big dream, a neighborhood pizzeria. So let's meet Sarah. Sarah is super passionate about making amazing pizza, and she has this dream of opening her very own place, Sarah's Pizzeria. But like with a lot of great ideas, there's a problem. Her business plan is solid, but she needs $100,000 to get it off the ground, and she only has $50,000 saved up. And this exact problem, this funding gap, is literally why stocks were invented. So what's she going to do? She could try to get a loan from a bank, sure, but she decides to go a different route. She's going to sell off pieces of her company to raise the money. So she divides the entire ownership of her future pizzeria into 10 equal shares. She keeps 5 for herself, that's half the company, and offers the other 5 up for sale. And this, of course, brings us to the other side of the equation, the investor. This is where someone who really believes in the idea comes in to buy one of those slices of the company pie. So let's meet Alex. Alex is a huge pizza lover. He hears about Sarah's plan, and he gets really excited. He totally believes in her dream, and he wants in. The math here is pretty straightforward. Sarah needs to raise that missing $50,000 from those 5 available shares. So that prices each share at $10,000. Alex believes in the pizzeria's potential, so he decides to invest and buys 1 share. And just like that, with his $10,000 investment, Alex now owns 10% of Sarah's Pizzeria. He is officially a shareholder. This means he gets 10% of the profits, 10% of the company. He's a part owner. So Alex is in, he's a part owner, but his journey is just getting started, because this is where we get to the real heart of investing, the risk and the reward. That $10,000 he put in, it's not just going to sit there. Its value is now tied to the success of the pizzeria. Let's fast forward 5 years. Scenario 1, the pizzeria is a massive hit. People love it. The whole business is now worth $300,000. That means Alex's 10% slice has tripled in value. It's worth $30,000. But what if things went the other way? In a tough market, maybe the business struggles and its value drops to $80,000. Well, now Alex's share is only worth $8,000. He's lost money. And that, right there, is the fundamental risk and reward of owning a stock. You know, this constant potential for thrilling highs and scary lows is exactly why people often say investing is a bit like a roller coaster ride. It really does capture that mix of excitement and, a little bit of fear. So a small pizzeria, that makes sense. But how do we get from Sarah's Pizzeria to the giant global companies you hear about on Wall Street? Well, it's the exact same principle, just on a much, much bigger scale. So with all this risk we just talked about, why do people do it? Why invest at all? Well, it really boils down to 2 main ways you can make money. The first is what's called capital gains. You hope the company gets bigger and more successful, so your shares become more valuable, and you can sell them for a profit. The second way is called a dividend. That's when a successful company decides to share some of its profits directly with its owners, the shareholders. Now, if Sarah's Pizzeria became a huge national chain, she might decide to go public by listing it on a stock exchange. You've heard the names like the New York Stock Exchange or the NASDAQ. All that is a giant marketplace where anyone from the public can easily buy and sell shares in her company. So if any of this has piqued your interest, what are some of the key takeaways for any beginner? Number 1, learn as much as you possibly can. Education is everything. 2, a really common starting point is to just consider the companies you already know and use in your everyday life. And number 3, and this one is so important, spread your investments out. Don't put all your eggs in one basket. That's how you manage risk. And there you have it. From a local pizzeria's dream to the engine of Wall Street, a stock is really just a piece of a business. It's your share in its failures and hopefully its successes. Which kind of leads to a fun question to think about. Now that you know what it really means to be an owner, what company out there would you want to own a piece of?